everyone, welcome back to our Accounting 210. In this video, we continue with the chapter 9, the master budget. Last time we finished our second learning objective, we finished the operating budget, right? So today we go to talk about the financial budget. So before we go to that part, I want to give you an overall picture. So financial budget, what statement it will give you? It gives you the income statement or the balance sheet. I'm waiting for you to tell me. It should be the balance sheet, right? It should be the balance sheet. Okay, so now let's look at our detail. We want to have a capital expenditure budget. We want to have a cash budget. Cash budget is the main thing. You definitely will have a question for that part. And then it just goes to our balance sheet. Sounds easy, pretty easy, right? So now let's look at the detail. Okay, let's look at the detail. Make it larger. Sorry about that. I should have done this early. Okay. Prepare the financial budget. We said financial budget. We talk about the capital expenditure and then cash budget. Cash budget, you have two parts. One is cash collection. One is cash payment. Okay. So right now, so many budgets, basically three. In this video, we focus on the first one, capital expenditure budget. Capital expenditure budget. First thing, what's the meaning of capital expenditure? We will talk this more in chapter 12 when we do our like the capital budgeting or that part. But capital expenditure is the one that you want to invest your budget, your intention to invest in new property, plant, or equipment. So basically, it's our long-term assets, right? Long-term assets. So property, plant, and then equipment. Plant, property, and equipment, they are long-term assets. So that is why we call it capital expenditure. They are not the expense, but they are capitalized. They are the long-term assets in our balance sheet. So let's look at our example. The company expected to invest in new computer, printer, delivery van, all of this in January. The depreciation expense show the operating expense, right? So when we do our operating expense budget, we said there were the depreciation. So the depreciation are from here, actually from these long-term assets. Okay, so it's pretty straightforward. So if January we want to buy computer, we want to buy van, we want to buy equipment, whatever we want to buy, whatever we want to invest, we just have that budget. So basically, it's January we will spend $125,000 on our long-term assets. February, March, we don't have any plan to buy long-term assets, so everything will be zero. That's it. So that will increase our long-term assets. And then because we have our long-term assets, remember, so whenever you have long-term assets, you will have depreciation. So that is our depreciation. Right? You will have our depreciation. So that's how do we link everything together. But for capital expenditure budget, make sure it's for long-term assets. If you buy inventory, that is not a capital expenditure. That is just your for your inventory, right? For your inventory. Okay, so next part we talk about cash collection budget. This is definitely the most important. We will practice at least two questions together. So hopefully you feel better after practicing. But you definitely will have a question from cash collection budget. You will say, why is hard, right? Just close your eyes and think about cash collection. Why you think it's hard? Because when you sell on credit, right? You sell on credit. Some people they pay you this month, some people pay you next month, some people even pay you 2 months later. So the money you collect now, let's say we just make assumption now it's July, right? So so at the end of July, some people already pay you, your customers, the 20% they pay you the money you collect in July, 20% is from your July sales. Maybe 50% is from your June sales. And you also have a 20% even from May sales. And you have 10% you will never collect it as a bad debt, right? So your July sales doesn't mean you will get the money in July. And the money you get in July is not just from your July sales. So that is the timing. The timing is very important. The timing is very important. For cash sales, there is no doubt. There is no question. You sell at the cash, you collect the cash immediately, right? So our cash collection, first is the cash sales. You collect the cash immediately. And then the second part is the credit sales. Credit sales from your this month, this month, from your last month, or even you can from your last month, Okay, but cash sales, you say, hey, how did you get this? 120,000, how did you get this? We got this in our sales budget, right? Remember our sales budget. Remember we said, hey, look at here. This is what we need. This is what we need. When we do our sales, we said 20% will be the cash sales. So we had 120,000 there. We have 120,000 there. So cash sales is always collected the same month. But for credit sales, I talk about brief idea here. We practice one maybe next time. So hopefully you feel better after practicing with me. We have our credit sales net 30 days, which means you have 30 days to pay, right? Based on the collection history, you expect that 85% will be collected in the month after the sale, 14% will be collected 2 months after the sale, and then you expect one will never be collected. Remember, we talked about in the operating expense budget that 1% is our bad debt expense in our operating expense, right? So 85% will be collected next month, and then 14% will be collected 2 months after the sales, and 1% will never be collected. Think about this, very important logic. Let's think about this. So you have a January, you have February, you have a March, and then you also have what? You also have a December, you also have a November, right? So you have all these months. When you do cash collection, you always collect the cash from your previous month. So for January sales, you collect the cash from your January sales. You also collect cash from December. You also collect cash from the sales in November. You never look at the after January sales. When you collect the cash, you always collect cash from the sales made in the previous month, right? So for November, you made sales, some money may not be collected, you collect it in January. December sales, some will be collected in January. January sales, some will be collected in January. So think about this, is very important. They said 85% of credit sales will be collected in the month after sales. So for our December sales, 85 of the credit sales in December will be collected 1 month after December. So for our, you have to know our forecast is our January cash collection, right? So we talk about cash collection in January. We said for December sales, 85% will be collected in the month after the sales. 1 month after December will be January. So our January will have 85% of the credit sales in December. Okay? Our January will have 85% of credit sales in December. 14% of the cash will be collected 2 months after the sales. November, you had sales. 2 months after November will be our January. So we said the January when we collected the cash, 14% of the credit sales from our November, And then we also have 1% will never be collected. And then we also have our 120,000 of the cash sales in our January. So our January cash collection has these 3 parts. 120,000 of cash sales, 85% of the credit sales in December, 14% of the credit sales in November. So this is very, very important when we talk about January cash collection. So your January cash collection for credit sales, 85% of your December, and then 14% of your November. So of your credit sales, So for your January, your total cash will be cash sales from your January, 120,000. We got this from the sales budget. 85% of our December credit sales, 14% of our November credit sales. So all these 3 will give you January cash collection. So your January, you collected 85% of your November, and then 14% of, 85% of your December, 14% of your November. February, you will collect 85% of January, and then 14% of your December. So your December, 85% will be collected in January, 14% will be collected in February, and 1% will be our bad debt, right? So for our January, 85% will be collected in February, 14% will be collected in March, and then 1% will be never collected as bad debt expense. Does this make sense? I want to stop here and I want you to tell me, hey, I still have some questions. Oh, I understand it. You definitely will have a question from this cash collection part. Once you got the logic, you will be fine. But if you don't get the logic, always email me and ask me. I want my students to understand this part. Okay, I'm not joking. Okay, think about this and then we do a practice together in the next video. Okay, thank you. I see you next time.